Welcome back to the Deep Dive. Today, we are cutting straight through the noise of the Vasta Platform's third quarter 2025 financial results.
Yep.
And this call is pretty crucial because it basically closes the book on their 2025 sales cycle and gives us a real sense of where they're heading next year.
Exactly. And for anyone tracking the education sector, Vasta is a real heavyweight. They're a dominant player. The market, it really just wants to see one thing.
Can they keep up the growth?
Can they keep up that aggressive growth and prove they can pull serious cash out of the business at the same time? And the answer this quarter was a pretty resounding yes. But the story inside those numbers is fascinating.
Okay, so let's hit the headlines. Top line for the 2025 sales cycle, net revenue reached $1.737 billion.
Right, that's 1.7 billion Brazilian reais.
And that's a very solid 14% increase compared to the last cycle. Adjusted EBITDA kept pace, hitting our $494 million. That's a healthy 10% year-over-year jump.
Okay, but hold on. That's our first aha moment right there. So EBITDA growth is 10%, but then you look at the bottom line. Adjusted net profit, it just soared 32% to our $82 million.
Right.
That gap tells you everything. It tells you management found efficiencies somewhere else, probably in their finance costs or, trimming other expenses. That's the first real signal of them tightening the ship.
But before we get too lost in the P&L, the metric that really defines this quarter is the cash flow.
Oh, absolutely. We have to talk about free cash flow.
Yeah.
FCF. The number itself is just phenomenal. It totaled our $316 million.
Which is an astonishing 117% jump from the last cycle.
Yeah, a triple-digit improvement. When you see a number like that, you immediately have to ask, is this real or is it just some, timing fluke?
And Vasta's own metrics suggest this is not a fluke.
Correct. You look at the LTM, the last 12 months, FCF to adjusted EBITDA conversion rate, basically how much of their paper profit is turning into actual hard cash.
And that rate.
It improved dramatically. 64%. That's up 31.5 percentage points from 2024. For this sector where you have these long collection cycles, 64% it's bordering on best in class. It signals extreme discipline.
So if overall revenue was up 14%, let's break that down. What parts of the business were really pulling the weight?
It's sort of a dual growth story. First, you got the bread and butter, the subscription revenue. That's the core engine. It grew 14.3% to $1.552 billion.
So that's almost 90% of their total revenue. High quality, recurring stuff.
And what's crucial is that this is the fourth year in a row they've kept that core business in double-digit growth. That just speaks to their market penetration.
And what's fascinating is the other part of that story. The secondary businesses seem to be growing even faster. Complementary solutions up 25.3% year over year.
That growth rate is huge, but this is where we see a little bit of friction in the numbers. Management pointed to that faster growth in complementary products as one of the key reasons the adjusted EBITDA margin actually dipped a bit.
Right, it went down to 20.4% from 29.4% last year. And that explanation was that these complementary products, they often require royalty payments to content owners. So if these are structurally higher cost products, how do they justify pushing for growth in a segment that actually squeezes their overall margins?
It's a strategic trade-off. That's the argument. Management is saying it's an investment, for scale and for client stickiness. They also spent more on marketing to lock in the 2026 sales cycle.
So they're taking a margin hit now for what they hope is higher volume later.
Precisely. But you hit on the critical question. If this complementary stuff eventually becomes, say, 20% of their revenue, Vasta has to prove that those products either become their own IP, which lowers the royalty cost, or they drive retention so high that the lifetime value just makes the lower margin worth it.
That makes sense. It's an investment story we have to keep an eye on. Now, shifting to just the quarter itself, Q3 net revenue was up organically 13.4%. What drove that specifically?
The non-subscription revenue in Q3 had a really sharp 45% increase. And that came from two main things. First, they rolled out new flagship Start schools in Sao Paulo. Those are their own bilingual franchise units.
Okay.
And second, they saw a really strong 21% jump in students signing up for their university prep courses. So that's a great sign they're successfully cross-selling to their existing base.
And we mentioned that discipline earlier. We can see it in their receivables, too. Despite a tough credit environment where it's hard to get customers to pay, their provision for accounts, it actually got better.
It did. The PDA, which is basically the money they set aside because they think they might not collect it, improved to 3.1% of net revenue. That's a 0.8 percentage point improvement in this environment. That tells you they've deployed the digital equivalent of a very, very effective debt collector.
Which brings us right back to that spectacular free cash flow. What were the specific things they did that drove a 117% jump?
Yeah, they were very specific. They basically automated their collections. Reminders, notifications, follow-ups, all put on autopilot. They also used customer segmentation to negotiate overdue payments much faster with different types of clients.
So that's streamlining the customer side. What about their own bills, the supply side?
They centralized their financial planning. And that move gave them the leverage to negotiate much better payment terms with their suppliers. Specifically, they were aiming for and getting one-year payment terms.
Okay, so that helps a lot.
Now, to be fair, they did acknowledge that some early collections from this sales cycle helped the numbers in the first half of the year. But even if you strip out those one-time benefits, they're still forecasting a full-year FCF conversion rate of about 50%.
Which is still a big step up from the 41.8% they did in 2024.
A huge step up. That $500 million in cash is a real strategic weapon for them.
Let's talk about that strategy then. Looking at the two big growth areas outside of the core business. First, B2G or business to government.
The B2G segment is it's stable, it's growing. It brought in our $67 million in the sales cycle, and our $17 million that came in Q3 alone from some new customers and a big state contract.
It's not the biggest piece of the pie, but it's solid.
It's foundational. B2G contracts take a long time to win, but once you have them, they're usually very reliable recurring income.
Okay, so if B2G is the foundation, then bilingual education is the rocket fuel. The Start franchise seems to be where all the excitement is.
It is absolutely the growth vector. Vasta is now running 6 of these franchise units. 4 of them just opened this year. They've already signed over 50 contracts. But the truly eye-watering number is the pipeline.
What's the pipeline look like?
They have a list of more than 300 prospects that are actively in the conversion funnel. I mean, that is just a massive amount of potential new revenue.
And they're clearly confident they can convert them because they're planning to launch 8 new units next year, almost doubling their footprint.
That aggressive plan lives or dies on converting that 300-plus pipeline. It's a huge leverage point for the company. If they nail that, it could seriously accelerate their growth rate beyond what anyone is projecting right now.
And all this strong cash flow performance feeds right back into the balance sheet, which is so important. We saw some pretty aggressive deleveraging this quarter.
That's right. The net debt to LTM adjusted EBITDA ratio, that's the key leverage metric. It came down significantly to 1.75 times. That's down a massive 0.57 times from just last year.
And for our listeners, 1.75 times is a very comfortable level of debt.
Very comfortable. It shows management is serious about paying down debt. You combine strong cash generation with less debt, and you get a much, much lower risk profile for the stock.
So looking ahead, what did they promise the market for 2026?
They're staying confident. They expect that core subscription revenue to keep growing in the mid-double-digit range.
Yeah.
And they're not backing off on pricing power either.
What's the plan there?
For 2026, Vasta plans to price their systems at CPI plus 1% to 2%. That's the same strategy they've used for the last 5 years, which shows they can pass on inflation plus a premium to their customers.
And those faster-growing complementary products.
Also expected to keep their pace, expanding above 20%.
Finally, let's talk innovation. They mention AI, but with a specific focus on equity and personalization. They highlighted new tools for the Individualized Educational Plan, or IEP. Why that specifically?
Yeah, that's a great question. You see a lot of ed tech companies using AI for like general tutoring.
Right, homework help.
Exactly. By focusing on IEPs, Vasta is embedding itself deeper into the school's core administrative functions, offering an AI that can efficiently create and manage a custom learning path for every single student. That's a massive value add for administrators.
So it makes their core products stickier. It justifies the premium price.
It makes it indispensable. It's not just about tutoring. It's about next level efficiency for the entire school.
That makes perfect sense. It really locks them into the ecosystem. Okay, let's pivot for our final segment. And a reminder to everyone, this is purely for entertainment and discussion. We are not giving investment advice.
Absolutely not. We are putting on our most aggressive fund manager hats and pitching a trade idea based purely on the dynamics of this call.
So we're in the investment committee meeting. What's the core thesis for this, let's say, outrageous but plausible trade?
The thesis is all about the cash flow, the little margin dip. That's just noise. The real story is the superior FCF generation, that's 64% conversion, and the aggressive debt pay down to 1.75x. That combination fundamentally de-risks the stock.
Okay.
And the explosive part, the real leverage, is that 300-plus prospect pipeline in the bilingual business. The market is not fully pricing in what happens if they successfully execute on that.
So the trade is structured to capture that upside while hedging against some of the short-term bumps.
Precisely. The play is a long position in the equity, combined with a near-term short volatility play. We buy the stock, betting that Vasta converts, say, 50 to 60% of that bilingual funnel over the next 2 years.
Which would push their growth rate way past current expectation.
Way past. And how do we fund it and protect the downside? We fund it by selling premium on short-dated puts.
And the logic there is?
The logic is that the company's proven cash discipline and the strong 1.75x leverage ratio create a solid floor under the stock price. We think the tail risk is limited, even in a tough market. So we're basically getting paid by the market for taking on that risk while we wait for the bilingual growth story to play out.
So to wrap up today's deep dive, Vasta delivered resilient double-digit growth, but the real story is the phenomenal cash flow, driven by some serious operational discipline. And looking forward, the strategy is all about scaling that high-leverage bilingual franchise and using AI to make their core product even more essential for schools in 2026.
I think the biggest takeaway for you listening is this shift in management's focus. It's translating directly into cash, and that cash gives them the firepower to invest in their big growth ideas without needing to borrow heavily.
Discipline and growth potential.
That's a compelling combination.
A compelling narrative indeed. And as always, remember that everything we've discussed here is purely for informational and entertainment purposes. We are not recommending any investment actions. We just appreciate you diving deep with us today.